Here's something that would have been unthinkable 20 years ago. A company that isn't a bank, a startup you've never heard of, can now access your bank account, read your transactions, and move your money. Not by hacking anything, not by breaking in. Your bank is required to let them in. That's open banking, and it's the most significant regulatory shift in financial services in a generation. In this video, we're going to break down exactly what open banking is, why governments forced banks to open their systems, how the technology actually works, and what this means for anyone who uses financial services, which is everyone. To understand open banking, you need to understand the problem it was designed to solve. For decades, your bank owned your financial data. Not just held it, owned the relationship with it. If you wanted to switch to a better savings account, you had to manually move everything. If you wanted a Fintech app to help you budget, you had to give it your bank login credentials, which was a security nightmare. And if a startup wanted to build a better financial product, they had no standardized way to connect to your bank account. Banks had no incentive to change this. The harder it was for customers to leave or use competing products, the better for the bank. Customer data was a competitive moat, and they intended to keep it. So regulators stepped in. In the UK and European Union, the catalyst was the Second Payment Services Directive, PSD2, which came into full effect in 2019. In simple terms, PSD2 said, banks, you no longer own the customer's data. The customer owns it, and if the customer wants to share it with a licensed third party, you are legally required to provide access through secure APIs. That single regulatory decision cracked open an industry that had been closed for centuries. Now let's talk about how it actually works under the hood, because this is where most explanations get vague. Open banking operates through APIs, application programming interfaces. An API is a standardized connection point that allows two software systems to exchange data. In the context of open banking, banks are required to build and maintain APIs that allow authorized third-party providers to access customer account information and, in some cases, initiate payments, but only with the customer's explicit consent. There are two types of access that open banking enables. The first is account information access. A licensed third party, called an Account Information Service Provider, or AISP, can read your account balances, transaction history, and account details across multiple banks. This is what powers budgeting apps like Plaid Connected Services, where you link your bank accounts and the app pulls in all your transactions in one view. The app doesn't store your bank password. It connects through the bank's API, authenticated by you. The second is payment initiation. A licensed payment initiation service provider, or PISP, can trigger a payment directly from your bank account on your behalf, bypassing card networks entirely. Instead of paying a merchant with Visa or MasterCard and the merchant paying interchange fees, the payment goes directly from your bank to theirs. This is a fundamental threat to card networks, and it's why open banking matters far beyond just data sharing. The infrastructure layer underneath open banking varies by country, and this is where it gets interesting. In the UK, the Competition and Markets Authority created the Open Banking Implementation Entity, OBIE, which mandated a single standardized API specification that all 9 largest UK banks had to adopt. This meant that a fintech building in the UK could connect to Barclays, HSBC, Lloyds and NatWest using the same API format. That standardization was a massive accelerant. In the EU, PSD2 mandated open banking but didn't mandate a single API standard, so banks built different implementations, creating fragmentation. Companies like Tink, TrueLayer and Plaid stepped into this gap, building middleware layers that abstract away the differences between bank APIs and present a single clean interface to developers. Sound familiar? It's the same pattern as banking as a service, a middleware layer that takes complexity at the bottom and turns it into simplicity at the top. In the US, there's no federal open banking mandate yet, but the Consumer Financial Protection Bureau's Section 1033 rulemaking is moving in that direction. In the meantime, companies like Plaid and MX have built de facto open banking infrastructure by connecting to thousands of banks through a mix of APIs and screen scraping. It works, but it's messier than the regulated approach. And in Canada, open banking legislation has been progressing slowly, with the federal government consulting on a framework. The expectation is that Canada will follow a model closer to the UK's standardized approach, but implementation timelines remain unclear. Here's the number that tells you where this is heading. Open banking API calls globally exceeded 12 billion in 2025, up from under 1 billion in 2019. The UK alone has over 8 million active open banking users. The technology isn't theoretical, it's live, it's scaling, and it's being used every time someone links a bank account to an app, verifies their income for a loan, or makes an account-to-account payment. The companies positioned to benefit most are the aggregators and middleware providers: Plaid, TrueLayer, Tink, now owned by Visa, MX, and Yodlee. They sit between the banks and the fintechs, the same way BaaS providers sit between sponsor banks and platforms. It's the infrastructure layer that captures value regardless of which end-user application wins. So who loses? Traditional banks lose control of the customer relationship. When a customer manages their finances through a third-party app that aggregates data from 5 banks, the individual bank becomes a commodity, a pipe for holding money rather than the primary relationship. Card networks face a longer-term threat. If payment initiation through open banking (APIs) becomes widespread, merchants can accept payments directly from customer bank accounts without paying card interchange fees. Visa's acquisition of Tink, an open banking platform, is a defensive move to stay relevant in a world where payments might not need card rails. And screen scrapers lose. The entire reason companies like Plaid originally relied on screen scraping, logging into bank websites on the customer's behalf using their credentials, was that banks didn't offer APIs. Open banking mandates APIs, which makes screen scraping unnecessary and eventually blocked. Here's what I want you to take away from this. Open banking is not a product, it's a regulatory and infrastructure shift that redefines who controls financial data. The answer used to be banks. The answer now increasingly is the customer, through whichever application they choose to authorize. The countries that have implemented it furthest, the UK and EU, are seeing real results. More competition, lower costs, and financial products that simply weren't possible when every bank was a locked vault. The countries that haven't, including the US and Canada, are building toward it, because the competitive pressure from markets that have open banking is too strong to ignore. If you want to understand the infrastructure layer underneath open banking, how APIs connect banks to fintechs, and who the major players are, that's covered in our video on fintech infrastructure. Watch it here, and if this breakdown was useful, subscribe. We put out 2 videos a week on the infrastructure and business models behind modern finance. No hype, just how it actually works.